Let me go across to Mr. V.K. Sharma and Prateek Agarwal. I'll start off with Mr. Sharma. If one looks at what is happening across the world, especially in the US markets, we saw the Dow hitting a record high and hitting a record high on high valuations. Now, the question is that are we going to see financial markets, whether it's in the US or India, go up because bond yields are down, other things aren't doing well, so this is the only place to put in money in?
Yeah. I think it is, first and foremost, good morning Anando and good morning Rajat, and thank you for having me over after a long time. Our sense is that the bull market is now beginning again, all over again, and there is more risk to the market in being out of the market than being inside. So you ought to buy these markets. We have been gung-ho on the Indian markets ever since the budget day, before the budget event, and even today, if you look at our own markets, I think the Nifty, or rather all the stocks that are quoted on the BSE, the number of stocks which are above their 200-day moving average is 65% as compared to when the Nifty hit a high of 9120 in March 2015. At that point of time, the number of stocks that were above the 200-day moving average were just 55%. So inherent, we are on a very strong market. And there are other reasons which we can elaborate later, why India will continue to attract FI investments. But globally, what has not happened is that we were expecting an contagion impact out of the referendum vote in UK. That hasn't happened, and therefore the markets have gone on in rebound, and they are now on to newer highs. When the markets go to newer highs, you ought to increase and not decrease your exposure to the market.
Great. Prateek, 2 points. I want your response on the thing that I was saying, that if you're looking at the way in which the US markets have gone up, commentators there feel that it is perhaps a beginning of a bubble, and it's happening because bond yields have dropped to an all-time low, 10-year low, so the money has to go into equities right now.
Yeah, so in India, one can keep checking for symptoms of the same, but our sense is that as of now, this is a market which is still rooted in sanity, maybe a bit on the expensive side, but still rooted in sanity. This is an economy which seems to be accelerating, inflation in control, monsoons being good. GST, well, there are expectations that it happens, and earning momentum starts going forward. So while this quarter may be just about even, yet there are pockets which are showing strength. So if we look at the market composition in India, there is enough to look at and feel positive about.
I just want to pull up one graphics plate that we showed in the morning. What we did was we took out electrical machines and from the IIP, and we recalculated what the IIP number would show like. And we saw that obviously there was a mild positive surprise, 1.2%, when we were expecting it to be more or less the same or contract a little bit even. But you take out that electrical machinery part of it, and the IIP actually looks even better. It actually shows you, which is the last plate that we had, which essentially shows you that without electrical machinery, the IIP number shows about 3.4%. And electric machinery is actually just 2% of the total IIP. Prateek, that seems to show that things are not as bad as people have been talking about.
No, sure. So there are signs of upticks in parts of the economy for sure. I am not too keen to slice and dice numbers, because all past numbers would also have impacts of such one-offs, which may either pull them up or pull them down. I think it's best to look at trends of things that where numbers come in on a regular basis. So auto sales are a good way to look at the market. They've been holding up while growth may have slowed down a bit. Look at how cement prices are behaving. The strength in cement prices would kind of indicate that the demand is buoyant, or at least the outlook is buoyant. So, in terms of data which is of a more frequent nature, things do look to be kind of okay.
And I mean, even if you look at the IIP, which comes out every month, and look at the 2-digit level, and I know you said that you don't want to slice and dice it, but we also worked out a long-term trend on that. And even there, it's actually the biggest drag continues to be one particular pocket, which is electrical machinery. But in any case, let's the broad number that one looks at even in the trend clearly seems to be that consumer durables and basic goods like, as you mentioned, cement, metals, they are doing reasonably well. Now, how would one play the markets if that is the background one knows?
No, so as far as we are concerned, for us, the consumption part of the market continues to be the story to look forward to. Good monsoons help consumption, GST help consumption oriented businesses versus B2B businesses. So, in whichever manner you look at the markets today, be it sustainability of near-term earnings or predictability of future earnings, this is the part of the market to be focused on.
Prateek, are you in a position to name a few stocks?
The commission report and the implementation of the same, starting with. No, so I think consumer durables is a space to really look at, because once the pay commission money start to flow in, autos, consumer durables are the spaces where we do believe traction will build up. So already the underlying currents are strong, they would further strengthen. And these are also areas where pricing power is high. So, in various sectors, we do believe.
So would you continue to buy the banks with high retail focus?
Yeah, so that continues to be a secular long-term theme. Numbers would continue to be sustained, and hence valuations should continue to be sustained. However, my sense is, they are priced slightly stiffly. So going forward, the compounding in pricing, while it will still be very good, would probably lag compounding in profits.
Okay, so let me take up one which has come out with numbers, which is IndusInd Bank. And Prateek, I'm going to ask you first, and then I want Mr. Sharma to also give his views on that. IndusInd Bank. There was a term used at one point which was called cowboy banking, which is that you went and increased your loan portfolio, and in the process sometimes you ended up with risky assets, but you also grew very, very fast. IndusInd Bank appears to be growing dramatically, very fast, but that loan portfolio is a cause for concern.
No, so we would not believe in that manner. So the growth in part is also because they acquired businesses. The growth in part, the organic part, has sustained for a length of time. So and there is no stress that is evident in numbers. Wherever the bank has seen stress in the past, it has provided for that, come out and disclosed that before most others. So I really would want to believe in the numbers at this point in time.
No, Mr. Sharma, I know that you are, of course, would probably not want to, being part of another group, not want to fully comment, but as a commentator and someone who invests, IndusInd Bank, again, when I take in the historically an HDFC or an HDFC Bank versus ICICI Bank, HDFC Bank always seen as a more steady, slow, safe kind of a bet in the way in which it grew. ICICI Bank much more aggressive. And therefore, in 2008, we saw a period when ICICI Bank was, people did talk about the fact that ICICI Bank would be in trouble, could be in trouble. It actually sailed through and didn't, but we saw what happened to the stock price and the correction. IndusInd Bank, very robust numbers. How would you read the numbers, and how would you look forward to these quarterly numbers from banks?
I think this is one bank which has done pretty well and consistently so. What we like about this bank is the fact that the net interest income is the highest growth, 38% it grew, and that is the highest among all the banks, private or public sector, whatever you look at. This is very important. And obviously it returns to 25% growth in net profits, so that is also augurs well. And to address your concerns on bad loan portfolios, I think as the other speaker was also pointing out, the NPAs continue to be under let's say less than 1%, and in the stressed assets is less than 0.9%. So all put together, considering the fact that they are going to increase their branch network, the second half is going to be much better than what one will see in the first half, and also the pickup that you'll gradually see in the commercial vehicle segment, where I think they have an exposure of around 16%. Our sense is this is the bank in which you can hopefully and without much pain you can continue to invest and still beat the market. When beating the market means beating the Sensex, you will get superior returns and with lesser risks.
Right. Mr. Sharma, can you just talk about the valuations of IndusInd Bank? It's not particularly quite cheap. I mean, people are expecting huge growth.
Obviously, it is quoting at 3 times the FY18 book, but obviously these companies don't come cheap, and therefore when you are looking at this kind of a growth, obviously you'll have to pay this kind of a price, but the attendant risks are very low, so I'll still pay this price and continue to invest in IndusInd Bank at this price.
Right. Another large cap pick that you have is Tata Communication. What's the call over there? Telecom sector is not growing, so would you look to play, I mean, the data story or the data growth there?
Absolutely right, because there are concerns how the Reliance Jio pans out, and accordingly what is going to be the reaction of the other players in the market, whether it's Idea, Vodafone or Bharti for that matter. I think this is one particular story where you can continue to sit idle and be a part of the telecom story, which will gradually become good, because the explosion in data has ensured that Tata Communication makes profit, and the fact that if it is able to reduce its debt, which would be after the sale of the current assets now around 9,000 crores debt, so that further when it will get reduced, I think currently one needs to look at that this particular company pays more than 20 rupees as earning per share in terms of interest, and the data and the debt will definitely come down with the passage of time by selling of various assets. And more importantly, the moment the government decides that we are going to allow now Tata Communications to increase their equity, the debt has increased because the government has not allowed Tatas to increase their equity. If they were to increase their equity, the government's shareholding would come down, and therefore the debt will automatically get reduced. And what you've seen is whenever you see debt reduction in a company with high debt and with increased earnings, the jump in the capital market cap is to the extent that whatever you reduce debt, that much the market cap goes up.
So basically an ROE expansion.
Yes, definitely, and it also let's not investors forget that although you may not have been a part of this company when BSNL was privatized in the year 2001, but the fact is that when you buy from the market, you are eligible for that land holding,
right,
which whenever the government sells.
Right. Prateek, what will be your view on something like an ONGC and Oil India? I know you cannot talk about stocks, so probably the sector. ONGC, Oil India, big underperformers, but now we are getting some news flow which may suggest that, not only oil marketing companies, but other oil sector companies may also do well.
No, so if kerosene prices move up in the market, then obviously the stress on the upstream and the government reduce. As of now, it is not clear as to who benefits. If we believe that all the increase goes to the upstream oil producing companies, then let's say 4 odd rupees from 4 2 odd rupees from here, a lot of their stress would evaporate. But we would want to first understand as to whether how the benefit is split between the government and the upstream.
Right, Prateek, thank you so much for joining us this morning. Mr. Sharma, always a pleasure talking to you.